This case study examines the impact on sell or hold's assessment when the investor has limited borrowing capacity that restricts their options. In this case, the investor has ample equity, enough to buy a replacement property over $1 million in fact. However, their borrowing capacity limits them to a property of a lot lower value, even less than the one they currently own. Should they sell it or hold? All right, let's quickly run through some of the key figures to get a handle on what this investor has. The property's current value is estimated at $900,000. The yield is pretty good, especially for a house in Sydney. It's around 4%. There's a $600,000 mortgage, which means there's $300,000 worth of equity. It's negatively geared by about $200 per month. Now, the exit costs would be around about $50,000 if they decided to sell, and the major expense is, of course, capital gains tax, which comes to $30-something thousand. The property was originally bought for $700,000, so it's grown by $200,000. The money the investor would have after tax, if they sold this property and reinvested all the sale proceeds, would be around $270,000. That's easily enough to buy $1 million replacement property, assuming they could get a loan-to-value ratio of 80%. However, they've entered a borrowing capacity of $500,000. They entered a current loan size of $600,000, but now the borrowing capacity is down to only $500,000. So the existing property has a loan currently of $600,000, but they believe they can only get a loan for a replacement property up to $500,000. Now, how is it that they can only afford a $500,000 loan when they currently have a $600,000 loan? Well, there can be reasons. Perhaps they've taken a pay cut since they purchased this property. Perhaps they have acquired a few dependents along the way, or are semi-retired now, or there's been a change in lending policy, possibly even an increase in interest rates. Whatever the reason is, they have consulted with a lender or mortgage professional, and they have found that they have a borrowing capacity limitation of $500,000. In fact, the target price with that borrowing capacity limitation is around $730,000. That's currently. But if I just remove the value from the borrowing capacity field and scroll back down, we can see that the system recalculates the replacement property target price to just over $1 million. So there's more than $250,000 difference there. I'll just restore the borrowing capacity field back to its original value, and you can see that the system recalculates back to around about $730,000. All right, so without this borrowing capacity field, sell or hold might suggest alternative property markets to the investor, which they would only find out later were too expensive. Not good. This highlights how important it is for investors to make inquiries with a lender or mortgage broker to determine if there are any limitations to their finance. Don't just assume that what you had in the past will still apply in the future. Oh, and at the same time, you might like to get an indicative interest rate from them too. Okay, is this an open and shut case? What do you reckon? Should the investor hold since they can't afford to reallocate their funds into a more expensive property? Let's move on to the list of alternative markets to see what options are available. The system scans the Australian property market looking for properties within the target price range that reside in suburbs with great growth prospects. The system also forecasts growth for the investor's current property. Note that there's $117,000 anticipated to flow in for this property, and that's over the next 3 years. This means the system expects growth of a little more than 4% per annum in this market. Remember, it was a $900,000 property. But the system shows that the investor would actually be better off by $47,000 if they chose to buy a replacement property in the top-ranked alternative market, which is the one that was selected earlier. Plus, they'd have $85,000 in spare funds left over. You might be wondering how come the investor has so much spare funds left over if they were to buy in this alternative market. And the reason is that although they have $270,000 in post-tax sale proceeds, they can only borrow $500,000. So assuming they borrow $500,000, they only need to contribute a deposit of about $160,000 and the entry costs. And that leaves them with over $80,000, which can't be contributed towards the investment. That $80,000 could, however, be thrown into an offset account to reduce mortgage interest, and it's lying there as a buffer in readiness for when repairs and maintenance pop up, or it could be used for a reno. By the way, probably a good idea to wait a year after you've purchased the property before doing the reno. That way you can claim those repairs as that reno as repairs and maintenance. Anyway, let's pick this top ranked market, generate the report, see what insights it has to offer. Okay, so I generated the assessment report earlier. This is what the system came up with. The executive summary suggests selling and buying elsewhere might actually be worthwhile considering. Notice that although there are nearly 2,000 markets with better growth prospects, there are only a bit more than 100 with growth forecasts high enough to cover the recycling costs within 3 years. As you can see from the first chart, the alternative property market looks set to outperform the current one by 122,000. That's over the first 3 years. But there's 75,000 in recycling costs, remember, so the net position after 3 years is actually only about 47k, and you see that easily on the second chart. All right, let's fast forward down the report to the net forecasts. This is where growth, rent and expenses are combined, and we can see how closely these two markets perform. There's the minus 75,000 recycling cost, which needs to be recovered. And you can see that although the alternative market does outperform the current one, there's a lot of overlap in the shaded sections, which means there's not a significant difference in performance expected. Let's move down to the observations section for some more insights. You can see that there are a couple of observations where the system considers it unclear what to do. These are the paragraphs with amber traffic lights. The first paragraph, for example, is assessing the property by the degree to which the investor will be better off as a percentage of the replacement property's price. It's only 7% in this case. The system wanted to see a higher figure. It's not bad, but it's not good either, hence the amber traffic light rather than red or green. Now the second paragraph is fine. Over 100 alternative markets are plenty to choose from, and that indicates that the current property market is not that flash, comparatively speaking, when it's compared to other opportunities elsewhere around the country. The third paragraph is also pro-sell. The demand to supply ratio of the alternative market is 17 points higher than the investor's current property market. The fourth paragraph is cause for some concern. Being only better off by 47,000 after 3 years isn't so rewarding as to make the effort worth the risk. Now, it all comes down to how much that amount of money means to an investor. The system is unsure whether this metric is good enough, hence the amber traffic light. Now, the fifth paragraph compares 47,000 with the recycling costs, which, as you'll remember, was 75,000. If the investor will be better off by a significant portion of the recycling costs, then it might make the effort worthwhile. As a minimum for assurance, the system is looking for 60%, and in this case it was 63%, just passed. And lastly, as we expected, the system doesn't like how much overlap there is in the net forecasts of the charts we saw earlier, and neither do I. So overall, the suggestion is to sell and buy elsewhere. However, it's not the most convincing argument. Anyway, the idea of this case was to examine the impact of a borrowing capacity that lowers the target price range, restricting the investor in their list of alternative markets. And Sell or Hold easily handles this case via the borrowing capacity field.